All right, we are live with Let's Talk Markets Live on this beautiful May 8th. Thrilled to be joined by Elliot Banks from BMLL. Elliot, thanks for jumping on the stream here.
Hi, Dave. Thanks for having me.
Yeah, coming to us from Britain, and well, I'm in Canada, but I'm an American, and so big news today. Big trade deal was signed between our two countries. Thank goodness we can put all this madness behind us. Except it's not a deal, it's just a framework, I hear. Doesn't actually do a lot. I don't know if you're paying attention. We're going to talk tariffs, but
yeah, we can certainly talk about how the markets have done it as well. And obviously there's an American Pope now as well.
There's an American Pope. The smoke is white. How about that? It's from Chi-Town, baby. It's from Chicago. I love it. It's about time, I think, we had an American Pope. He doesn't seem to be too fond of U.S. politics, judging from his Twitter account. So we have a Pope with a Twitter account. Some fascinating stuff. What a world we live in these days. So, when it comes to markets, we tend to talk on the show about big picture stuff, policy changes, regulatory initiatives, cataclysmic economic events. And it's true, a lot of this, a lot of what happens in markets comes down to these splashy headlines. And investors, tend to make decisions based on that, for better or for worse, of course. But beneath all the policy events and the vibes, there's a ton of data, nonstop, onslaught, massive amounts of hard data. And, that tends to be, that's where most of my career was focused, was on all this data. And we're, really excited to talk to you guys. BMLL Tech is one of the larger providers of all of this data. They provide historical data, analytics on global capital markets. You'll tell us all about that. But I think it means that you guys have, sort of unique insight into what the impact on markets is from policymaking, market structure debates. And of course, we're one of your clients. We get a lot of our data from you guys, and it is, I will say, exceptional and pristine, and one of the better data sources we've gotten to use in our analytics work. So today we're welcoming BMLL's Chief Product Officer, Elliot Banks, to find out where this data comes from, how our firm's using it, and what can it tell us about things like tariffs, tick sizes, and we'll get into 24-hour trading too. So thanks, Elliot.
Well, look, thanks a lot, Dave, for having me. And I think absolutely the data aspect of it, certainly, in my time at BMLL and in the markets, has just grown and grown and grown. And we were talking earlier, we had 8 terabytes of options data on one day that we received, a couple of weeks ago. Just the scale of it now is absolutely enormous, and trying to make sense of that, trying to turn that into something you can actually action is, becoming more and more critical at the same time, because you've not only have you got this data being produced, but then you've got all of this tooling, all of this new technology that's kind of coming in together and wanting to actually understand it, use it, utilize it, whether it's AI, machine learning type tools, whether it's best execution, whether it's understanding regulatory impact or impact of certain events. And the explosion in data is certainly something that we're hoping to try and help people make sense of it, really, because one of the big things we found is data on its own is just noise unless you've actually got it cleaned, organized, gathered, and made in a sensible way to actually be used.
Yeah, I think people, unless you've worked in market data and you've dealt with the massive amounts of data and often, the problems in that data, I think few people kind of appreciate how difficult it is. And they assume that the data is pristine, that it's always perfect, that there's no such thing as glitches or data artifacts or problems. And they assume that you can find simple answers really quick. And like you're saying, a single day of options data on a high volume day being 8 terabytes, right? So imagine trying to do analysis of options data over months.
Exactly.
it's hard, right?
It's really hard. It's really hard. And actually, maybe if I take a step back and for those who don't know BMLL, just explain a little bit
Yeah,
about
please do.
what we do.
Yeah.
So we focus on historical data, and that's actually quite unusual. Most market data providers, market data vendors are providing real-time market information, whether that's at level 1, 2, or 3, and I'll explain what that is in a second. But we focus on history, and we focus on making that historical data really, really clean, really, really accurate, really, really usable. So we take all of this data and we take it either directly from the exchange or captured where the exchange is in the same data center at what we call the level 3 level. Now, what that means is every single order, every single insertion, cancellation, correction, every single message that's coming out of the exchange, we take. And we do that from pretty much every equity venue on the planet now. We announced recently we've got MSCI developed, fully done. We've got the majority of the emerging markets, MSCI emerging as well. So we really take that all and we store it in the cloud, and then we make it usable for quants, for data scientists, for analysts, for people to come in, query, access, and analyze that data for looking at the impact of tariffs, regulation, feeding into a smart order router, finding alpha, whatever use case you have for actually being able to accurately come in and get it, and dealing with some of the challenges that you alluded to.
Mm-hmm. So how many do you, maybe I'm putting you on the spot, do you know off the top of your head, how many exchanges are you pulling data from now?
Well, we've said over 100 for a long time, but it really is very much, it is a lot more than 100. I mean, it's probably 115, 120. I mean, we've got to the point where we've kind of stopped counting. The thing we say is we do 99% of global traded volume in equities, which really, we have, and I don't want to disrespect any exchange. We have the likes of Iceland, the Baltics. We have obviously all of the US markets, and I think we're going to talk a lot more about US structure and some of the data that you get there. Canada, Brazil, Europe, South Africa, Japan, China, India. So really, you name it on the equity side, we've got it now. And certainly any market that trades somewhat with some level of liquidity in a somewhat electronic way, we kind of cover now, and we continue to add venues all the time. It's one of our biggest pushes, and one of the things we continue to do is to continue to grow that global coverage. That's in equities. We then cover the major futures venues, so CME, ICE, Eurex. We recently onboarded JSE and ASX derivatives as well, and we're continuing our growth in those asset classes. And actually, one of the really interesting things, which we've seen a lot of interest in, was actually US options. So we at the end of last year onboarded 6 years of unconflated tick by tick options data through the US options market, which even getting the data was a challenge in itself, right? It was an engineering effort to ship it from the data centers and where we were taking it historically just into our cloud, right? It took real engineers real time, just because of the size and the scale of it. You're not talking.
How much data is that?
It was about 5 petabytes.
5 petabytes.
Wow. And I'm trying to think of like some analogy to it's just an enormous amount of data. At a scale that, even putting it into the cloud, even taking it, so you sort of take it, you put it into the lowest level of storage you can get, even taking that out to look at a bit of it costs you a lot of money. So you've got to be very careful in managing that and making sure that you can process it in the right way.
And how did you ship that all, like with hard drives?
No, luckily where we were getting it from was all already in AWS. So we're fully AWS native. Right. We're already in the cloud. The firm who had captured it for us, they already had it in the cloud, so we were able to ship it and take it. I think otherwise, it would have been very much a case of using something like AWS Snowball, which is where they literally send
Snowball. That was it. I was like, is it Iceberg? Nope, it's Snowball. Right.
And something they stopped is, I don't know if you saw this, they used to have a product called Snowmobile, which was basically a haulage truck full of these snowballs but
Yeah.
cooled and everything else, because it was like if you're shipping like petabyte scale data,
Yeah.
you're not in the same data center. It's actually the fastest
It's
way.
the only reasonable way to do it.
Yeah. Literally the fastest only way, which doesn't cost you, tens or hundreds of thousands of dollars just to move the thing.
Yeah, people don't realize that the highest bandwidth options are sometimes a truck.
Yeah. or a
an
plane.
airplane,
If you go,
right?
yeah, exactly.
All right, so let's get into, I think we have a lot of people who tend to listen who have been in capital markets their whole careers, and we have a lot of retail investors who listen who, all they see is sort of the quote or the chart on the page. So why don't we get into, to start, like, what is level, you mentioned this before, level 1, level 2, level 3. What does that mean?
Yeah, so level 1 is what we call the top of the order book. So it means the best bid and the best offer. And actually, I'm just going to try and find on our website a lovely little picture of that.
Okay.
Let me just pull it up for you now, because we've got a really nice little picture that shows present. Let me share my screen. Here we go. So here we go. Can you see that?
All right, I think if I do this and that, there we go.
Perfect. So this is a really nice way to explain what we mean by level 1, 2, and 3. So level 1 is what, certainly if you're a retail trader or you're looking at the prices that are coming through, this is what you typically see. You see the top of the order book, so the best price, so the best bid price and the best ask price. Now, actually, there's a little bit more nuance, and I think maybe if we talk about US market structure in a bit, there's some differences between what if you're a Citadel, even if you're looking at level 1, might be different to what you're doing if you're looking at what we call the SIP or the MBBO. So there's a nuance there as well. But let's keep it at this point. Level 2 is then different price levels in the order book. So you, rather than just seeing what was the best price someone's willing to bid, what's the second best, the third best, the fourth best, all the way down. And we don't just mean, when we say level 2, we don't typically mean just say the top 5 or the top 10. We'll get exchanges where you can see like 200 levels of depth, 500, 5,000. I think we've seen at one point for some stocks in some markets. So you get all of that, but it's aggregated at price level. Level 3 shows you every single order where it's sitting in the queue. We can see when something is placed on the order book, when it's cancelled, when it's amended, whether it's corrected, and also what order was actually the one that was caused the trade, which is really important for a lot of use cases. Understanding, okay, not just whether it was whether what was the price that were there, but was a trade actually caused by a buy order or a sell order, because that sort of information can help people understand imbalances in the market, directionality of flow. So we have level 3 now. What level 3 gives you is the ability to create a really high quality level 2 and a level 1 product. But you can't go the other way around. You can't stop just the top of the book and go down to the step. You've thrown away that information if you do that. So that's what we mean by level 1, 2, and level 1, 2, and 3.
Got it. Yeah, so I think when people think depth of book, they're probably thinking level 2, because that's the kind of thing you can kind of look at and see. Whereas level 3 is more of the kind of thing you use as a quant if you're trying to really model order book dynamics and understand. We used to do, when we were doing research, we would try and understand like how responsive is our signal to a particular change in the market, and how would we slot into a queue in order to know whether and how likely it was to get executed. And then where you're at in the queue is very important for understanding when you're doing high-speed market making, for example, something like what's called adverse selection, which you don't want to be at the back of the queue, because if you get executed, it means the price is about to move against you.
Exactly. Yeah, and another common thing people look at is how long are orders actually sitting there. So if I'm seeing some liquidity, if I see a price, and actually I know orders aren't going to rest there very long before they get cancelled or move away, I might know that that's not necessarily the right venue I want to trade or execute at, versus something where there's longer resting times. The other metric that people use from that is to calculate how likely am I actually to get filled. If I place an order there, how likely is it that my order actually gets filled in the queue? Work out how long I might want to be there and be executed from. So all of that kind of those sort of order level dynamics means that you can quickly understand what the market is doing, feed that into, and we'll have banks who will feed that into a smart order router, working out their routing decisions. We'll have buy-side firms using that to work out signals where they want to place their orders, but also it gives you an idea of different types of participants. Are there certain parts of the day when people are reacting differently? So there's like there's a real depth of things that you can do. But importantly, if you've got that level 3 information and it's really high quality, building something that's level 2 or level 1 is a much easier thing to do as well, because you've got, any message you lose in the level 3, you've got to actually rebuild your book. You've got to replay what happened. So you've got to focus and have a really high quality data set, which enables you to then have even higher quality data sets in level 2 and level 1.
Yeah, I think that's a funny nuance that I don't know a lot of people understand. But when you're receiving this kind of level 3 data, you're receiving deltas, right? You're receiving update messages. You're not getting the state of the book at every update. And if you lose just a packet or just a message within a packet, the state of your book is now destroyed for the rest of the day, unless you can get some, backfill that information. And so keeping that data clean and reliable is actually a pretty challenging problem. Right?
Yeah, and the sort of things, the other challenge to that is when you take this data, you tend to take it over something that is inherently lossy. So multicast, which is the way that they distribute this information, loses information by definition. It's just the way that they can broadcast it so everyone gets it. Or multicast it rather than broadcast it. What that means is you have to do some clever things. So we have to take multiple copies of the data. We have to play through, and if you ever lose any information from one of your feeds, you have to go and get it from the other one and correct it and make sure it's available. That's the sort of thing which makes it for a really high quality data set. Because effectively what we've done is, as you said from your past life, what we've built is what a top hedge fund will have built on the inside, but what we've done is built that as an environment that you can then come in and access and research all of this without actually having to set up not just the data but the cloud infrastructure as well.
Yeah. Oh, it's a nightmare. It's you're giving me some PTSD flashbacks right now of multicast retransmission storms that were a real problem a long time ago, but I think that's an issue that's mostly been resolved. All right. So I think maybe this gives people a sense for what you guys do and why it's so interesting and challenging. We talked about how in the options world, years of history were 5 petabytes. When you're collecting data, even in real time, you're talking about hundreds of thousands, sometimes millions of events per second across multiple feeds. And it takes real computing power. But as you sort of get away from the raw data, I think there's some really interesting things that you can learn from the data that are, I think, maybe more compelling in terms of what people are tuned in for. So, why don't we start with tariffs? I know this is an area, obviously people are paying a ton of attention to tariffs and to, how they are changing and, what that means for markets. And we're seeing markets react in real time, trying to understand as best they can what's going on. And so, I know you guys have done a lot of analysis on this topic. So, why don't you start with that? What have you looked at? What has it told you? And what can people take from it to better understand how markets are reacting?
Yeah. So look, tariffs have been a huge thing over the last few weeks, obviously for a ton of different reasons. And where where we've sort of looked at it rather than the sort of macro picture. It's actually, what does that mean from someone who's trying to trade? And that's where we've seen, some really interesting insights that you can get. So the first one, and I'll bring up a few slides, a few plots in a second and talk through it. But the type of theme we saw was, first of all, well, where are people trading? So obviously the markets have reacted violently, and I'm talking here the sort of the week after April 2nd, when we had huge market volatility, huge price swings. It's what's the trading volume done? We kind of tried to look at that, but also how are they trading? Because there's certain ways that people trade. For example, in the US market at the moment, a large percentage, and I think on some days it can be 30% of the market, trades in the closing auction. A lot of volume goes through there. There's a whole ton of reasons why that happens. ETFs get a reference price, so any fund that's tracking that, they get that guaranteed reference price point. There's guaranteed best execution. There's a whole bunch of reasons why you might go to the auction. So that's kind of what we're seeing. We've also seen earlier this year, it was the first time in the US market that the threshold for the amount that was traded OTC rather than on exchange was more than 50%.
Yeah.
So more of the market was trading off exchange than on exchange.
Yeah.
So we could start to look at, well, what's happened there, and has that changed from what we saw? So if I share again, Dave, and you let me.
Okay, there we go. Yep.
Perfect. So what we've got here, nice and simple, and I know a lot of Americans are used to seeing share numbers when you do things. We prefer to use it in terms of notionals. It balances out a little bit more, because really from like an economic point of view, it's how much dollar amount has been traded rather than the number of shares. And there's reasons why the US does shares, which I won't go into, but this is the reason for we use notional, because it allows us to compare different markets in a bit of an easier way. So first of all, I think this was April 7th, large trading day, actually the largest I think possibly ever. But actually, here is the December triple witching day.
Wow.
So this is when the US option, the S&P futures, the options, and the monthlies all expire. So you tend to get huge rebalances, you get rolls of what goes on, and a lot of that is triggered by what's going on the equity market as well. So you get rebalancing, you get this whole effect. Actually, the volume was about the same. So you've got this huge activity, but actually the volume wise, it was about the same as what we saw in December. A huge liquidity event, triple witching day, very much large volume days. What was different is when you looked at it on the continuous trading. So in a rebalance day, everyone trades in the auction.
Yeah, the auction.
Everyone chucks it in the auction. That's when you're getting the actual price that will fix when that goes into that index, when it expires, everything else. So it doesn't tend to trade on continuous trading. But what we're seeing here is like a huge spike in continuous trading. So rather than it going at the end of the day, this is just happening all the time. So this whole shift from volume moving maybe OTC, moving into the auction, has actually shifted back, and there's a lot more volume trading, continuous trading. So which kind of ties into what you're seeing. So you get this huge shift, and this is the US. We saw exactly the same thing in Europe. Here's this nice purple bar. You can see the continuous volume just going through the roof. And this, by the way, is the same thing we saw during COVID. So in COVID, we had this huge flight towards people trading in continuous trading. They didn't want to do block trades. They didn't want to go in the dark. There was an order book, right? I can hit that. I'm going to get my volume and I'm going to get filled. And this ties into resting times in both Europe and the US dramatically falling. So this is how long an order is actually sitting on the order.
All of these tend to all match up with higher volatility environments, right? As volatility is increasing, trading goes on to lit markets, resting times decrease.
Exactly. So we kind of see this pattern, and this is a pattern which you will see again and again and again in any high volatility environment. So you kind of start to get a picture of what's going on there. And you know, we saw it in COVID. We'll see it again at the next volatility event. There will be a shift, and you know, you're likely to see higher volatility leading to shorter resting times and people moving towards continuous trading. So that's kind of one effect that we saw. The other one was, right, where is that actually, how much was happening? So one of the things that we put, which is not, I'll get one more plot up and then I'll talk about you know, this a little bit. So let me share my screen again. One nice plot I thought I'd show, and this I think is really interesting, just to show how important the US market is compared to the world. And this is where having US dollars everywhere is really nice. If I just zoom in a little bit so you can see it there. This is hour by hour trading volume over the week, and we basically grouped it into China and Hong Kong, Europe, Japan, rest of the world, Swiss, UK, and US. And you can just see how much the US market dominates that. You know, when it kicks in, everything kicks in. It just dwarfs everything else. So the US market really is the gorilla in the room compared to all the other markets. And I think this is just a really nice picture, just to show and explain exactly how big it is. What is also interesting, though, is look at what happened in China and offshore on April 7th. They obviously had a much more violent reaction because this was a bank holiday in China on the 4th. So they had this sort of built up, pent up demand, a bit like you know, previous major market crashes where there'd been storms and the exchange hadn't been opened. Here we get a similar picture, and actually China is trading almost as much here as the US was trading.
Wow. Yeah, look at that. Jeez. Fascinating.
Exactly. So that's kind of a different view of what was going on. And I think it's really, really interesting to see how that sort of that explosion during the week and then dropping down.
It's a good way to visualize how the US dominates trading as well.
Yeah.
You know, I don't think everyone, you know, necessarily appreciates that.
It always amazes me, especially, you know, being the other side of the pond in Europe, and the size and scale of the US market. You do have to sort of remind people that you've got small venues in the US doing more turnover than what's going on in you know, some major exchanges in Europe. Now there are structural differences as well. You know, it's never a one-to-one map, but it does give you kind of this picture of just how big the US market is in comparison to other parts of the world, and how much volume and liquidity goes through that market on sort of a day by day basis.
If you can, do you have that? You guys have this great chart that shows on exchange versus off exchange trading in the US and where it's happening. I think that would be worth showing people.
Yeah, let me. You put me on the spot now.
I know.
Let me find it. It's something that we do. We update once a month. It's called our liquidity maps.
Yes, liquidity maps.
So let me share that. And we have one for Europe and one for futures as well. And we've got a little video primer here explaining. But we have, this is a really nice picture, and maybe this is worth me talking for those who don't know about the market as well. So here for example, this is I can't remember which month it is actually. This is our latest one, so up to end of March. So this is pre tariffs.
Pre-liberation day. We are not yet liberated.
No, exactly. Exactly. So you can see roughly there's this split of on and off exchange. For those who don't know, off exchange we split into two groups. We split into, you know, what we call the wholesale brokers. So that's your likes of your Citadel, your Virtue, Jane Street, others. A lot of these names, by the way, are a bit legacy from when one firm or another has acquired them. But you can kind of work out who it is. Also, this very, very somewhat ironically named de minimis funds, which tends to actually be quite not
silly,
de minimis
right?
when you add it up.
We have pushed the SEC to get rid of that. They still have not. But yes.
And by the way, yeah, it's on any individual one, it's quite small, but when you add up, it's actually quite material. And this data, by the way, is all taken from FINRA. But we have sort of ways to pull it in as well. But you can kind of see, here are the OTC markets. So this is how, a lot of this volume is retail, not all of it. But it, at a first order approximation, this bit is kind of the retail bucket. There's other bits of retail which is quite nice, which we can talk about. Some of these exchanges actually have retail flags in the level 3, so you can see what volume has gone on exchange rather than being off exchange. But that's typically what you see. The other big bucket off exchange is the ATS. Here's UBS, Intelligent Cross, Crossfinder actually, Intelligent Cross. You've got lots of different ATSs, and this tends to be dark pools, hero auctions, trajectory crosses. There's sort of this myriad of different sort of institutional liquidity pools. So these are your dark pools, but actually the growth we've seen has been in a lot of sort of more, if you like, innovative forms of trading. So we've got a lot of innovative ATSs that have come on in the last few years. It's kind of been a big topic. The likes of One Kronos, Intelligent Cross, Pure Stream, and they're kind of coming in and offering slightly different mechanisms to what typically seen. That's actually something which is kind of spreading further and wider. North of the border where you are, Dave. A lot of these venues have come. I think Pure Stream is now on NASDAQ systems for their venues, and we're seeing a lot of it moving across into Europe as well. And actually, one of the hot topics in Europe is some of these ATSs moving and providing similar trading mechanisms on the European stage.
Is that as an MTF, or can an ATS operate in Europe?
So it's an MTF. There's kind of two routes that they're going. One is just they're called an MTF. It's kind of the same thing as an ATS for those who know. ATS is a alternative trading system. MTF is a multilateral trading facility. They're kind of the same thing. Japan, they're called a PTS. They all have these sort of slightly different names for something that's not an exchange, not under like the same type of structure of regulation, but you can still trade on. In Europe, it's slightly different to the US because we don't have a consolidated tape, so there's differences there. But these are either coming on as MTFs, so as a standalone trading facility, or they are partnering with an exchange. So a classic example we saw a few years ago was BIDS partnered with CBOE to do CBOE LIS, which was a mechanism in Europe. CBOE then later went on and actually acquired BIDS and integrated it. We've had a similar partnership with NASDAQ and Pure Stream, both in Canada and in Europe, but we've got others who are coming online who are building out. So the likes of One Kronos are launching standalone MTFs that are going to be available in trade.
Got it. Okay. Good. I'm glad we could bring this up. I think it's such an interesting way to visualize where trading is in the market. I mean, and this is just something that people can look at on your website, right?
Yeah, exactly. We can also, if you go on, I believe you can subscribe to receive all of this on the website. We've got sort of a market insight section, which I'll quickly show here, where we do lots of different analysis on data. We have our regular European and US liquidity maps. We have our view from a few features, which shows similar sort of market structure measures, but for some specific futures, both equity index futures, but rates futures, commodity futures. So sort of different sort of market structure type analytics, and these are all free and available within the website. So, and you can subscribe and access that.
Great. All right. Anything else on tariffs? think we covered it, right?
I think we covered it for now. I mean, one big thing we saw was just the spike in actual volume of data.
Yeah.
And we were saying it was 3 or 4 times average. I think our CTO looked at comparing it to like a real baseline, which you can take a sort of really low volume day as a sort of baseline, and it was 10 times more than Christmas Eve. Christmas Eve is a good one because it's like that is like the lowest day that you get.
Yeah.
So it's a 10-fold increase
Nice.
in that, which is huge. And I think I heard CBOE recently were on a panel and they were saying they processed 1 trillion messages on one of their exchanges, which is crazy. Right?
How many fields overflowed that day?
And of course the thing is as well, it's always the days people are interested in looking at. They want to understand what's happened. They want to understand how that's gone. So it's I think it's a story we're going to continue to look at. A lot of our customers using our data are continuing to look at, and I'm sure there'll be further piece of analysis that will come out, as and when more news comes in on that story.
Okay. All right. Before moving on, I just want to say hi to our friend in the chat, Carl Hungus, who obviously knows my favorite movie, and so I got to recognize that. Do you know the movie reference here?
No, I'm not.
No?
I'm not a good mover.
No, The Big Lebowski. You should. I don't know. It's a very niche movie.
Actually.
No. All right.
I know of it, but I haven't seen it.
Okay. I think I refer to it so much, people understand now. All right. So let's talk about 24-hour trading. This is, it's a hot topic in the US. Obviously, this is how crypto markets work. And so, you hear regulators talk a lot about this sort of conundrum that they're facing, which is, people want 24-hour trading, but there are lots of problems and issues with it. And it requires a lot of infrastructure changes. Now, that being said, we're starting to see proposals come out. I think there was one that came out from the SIP committee recently.
Yeah, it was the other day. I think they said that they're moving like towards
24/5 trading, basically. It seems like the kind of thing that the SEC is pushing the industry towards. So, what do you think about it? What have you seen from Blue Ocean and other ATSs, and what are there things that you can see when U.S. markets are closed but other markets are open that can inform this conversation?
Yeah, so Blue Ocean is obviously in the US the one which is sort of been first mover on that, and definitely is attracting some attention. I think on the topic in general, you can't go to a conference in the US at the moment without people talking about 24-hour trading, what it means, what's going to happen.
Yeah.
So I think it's worth saying. You pointed out crypto, but actually, even the CME is like 23 hours a day.
Yeah,
that trades from Sunday night to Friday night. They have like an hour's break. At I can't remember what time it is local time. There's some point during the day where it pauses. I think it's 10 o'clock at night or something for an hour, and then it rolls in. The options market as well in the US does actually have a global trading hour segment as well. So you can trade S&P 500 and Russell 2000 equity or 2000 options overnight on their global trading hours segment. So they have so it's not, crypto has obviously got a slightly different market, although there's a lot more institutional flow coming into it. But there is sort of a precedent already in some markets for 24-hour trading. Actually, if you look further afield, you've got Japan Next, which is a Japanese PTS. They actually offer overnight trading as well. So it's something that's been around. What's some of the interesting things and what's happening is there's certainly the demand is coming for the overnight coming into the US. So that's something which hasn't been seen on the equity market before. And the challenges which you alluded to on the exchange side. So for the ATSs, which we spoke about before, they are able to do this already. Blue Ocean is an ATS, operates overnight. we did some analysis on, which is on our website, where you can look at how what happened. I think this was the DeepSeek sell-off. Obviously, Blue Ocean, that was over the weekend. Blue Ocean was open Sunday night, so you could kind of see some of the activity that was going on the sell-off before the main markets opened on the Monday. Exchanges have a lot more regulatory and technical hurdles around doing it, which is the SIP committee has to decide. So for those who don't know what the SIP is, because we've spoken about it quite a lot, and this comes back to that earlier point we were talking about. The BBO, our level 1 picture, I sort of said, well, that's slightly different if you're a Citadel versus, you're a trader. The US market has something called the SIP, the Securities Information Process. So basically, there are 16 equity exchanges in the US, soon to be 17, 18 with Texas and others coming on. They will take their information, send it to the SIP, and that will get aggregated into a single what we call the NBBO, the National Best Bid and Offer. And that is the SIP, which then disseminates this information. The SIP then uses, the NBBO is then used by all of the brokers and all of the ATSs for their trading. So there's a lot that goes on from a regulatory perspective in terms of what you see from an NBBO perspective versus what goes on in the exchanges. So,
and there's only an NBBO during trading hours, right?
Exactly.
9:30 a.m. to 4 p.m.
Exactly. So what do you do outside of those hours? What happens when the SIP isn't running? The SIP at the moment is geared up to be, certain running hours. I think it has some extended hours as well, but not fully. What do you do for reporting? What do you do for settlement and clearing? So there's kind of quite a few questions that have to be answered there to sort of go into it. But the ATSs, they're already able to do it. Blue Ocean is the first, but there are others coming online. Bruce, Dream, there are quite a few who are sort of moving into this space. What's nice about Blue Ocean, and we've obviously got their data that we've got from that report that we did. That's what we call a lit ATS. So a lot of ATS, there's a lot of dark pools. You don't get any transparency. Their venue, they have it, and there is pre-trade transparency, which allows us to do this analysis on how Blue Ocean behaved on that particular day.
And so, have you spent any time besides just that analysis looking at spreads and volatility, outside of regular trading hours, as sort of, I would think, generally speaking, it's a very it's a dangerous time to trade. Usually, if I'm talking to retail investors, they're asking me what I think. I think you trade during market hours when the liquidity is there and when there is the protection of an NBBO. And we will regularly see outside of trading hours some pretty crazy price spikes, even with small trades. But it's people that are not getting great execution quality.
Yeah, I mean, look, I think you've got to remember that there's sort of different reasons possibly for 24-hour trading now to compare to something like doing it on the CME historically. A lot of the target market here is, and certainly my understanding is it's allowing other parts of the world to be able to trade US markets in their hours, because so it's less necessarily about can you trade sitting in the US on the US, but can you trade if you're in Korea or Hong Kong or Japan or wherever else to trade and do that. So there's definitely an aspect there of what is the reasons for being able to trade. Clearly, there are times when if you've got a strong conviction on a view, it might go one way or the other. Having access to being able to do that earlier or later is good. I mean, the US today has extended hours already. It's not, we say the market is 9:30 to 4. You can trade earlier or later as well, depending on how you're trading. So I think a lot will depend on what happens. What possibly feels a little bit different here is the momentum across the board to do this. It doesn't feel like it's kind of someone's trying to push it out individually as innovation. It kind of feels that there's a lot of the street and the market is kind of pushing towards something on this, but you're right. Monitoring best execution
Mhm.
will be really important in this environment, as of any environment. But I think people will be really important to sort of keep an eye on it, watch how it evolves. Certainly, there's a difference from being retail to institutional. There's a difference to being where you are in the world, and I think the important thing here in understanding it is having the data to actually be able to get an informed view rather than guessing one way or another, I think.
Mm-hmm. Mm-hmm. Yeah, and that's why I think it'd be interesting to see even today, the difference, for example, in spreads and volatility between extended hours versus regular trading hours. Like this is something we could look at right now to understand, there's a measure that was in a study I once read called extreme price moves. That's another one where I think you would see, just eyeballing the data, I think you would see far more extreme price moves in these lower liquidity extended hours trading sessions than you do during the day.
Yeah, what was interesting about the sell-off? Because obviously, look, this is the deep sell-off going back to.
Yeah.
What was interesting was, that was kind of our inbound. Oh, everything, there'll be wild spreads. It won't be very good. That was kind of the inbound hypothesis. What we actually saw, and bear in mind, 24-hour trading and overnight trading is still it's still a small part of the overall picture. But what we actually saw was, we took Tesla and we looked over the day and night, and maybe I'll quickly share this because it's a good little view of this. And again, this is on our website, on our market insights. But here we actually took the time weighted average spread for Tesla on the 24-hour period, and actually we saw, there was a really good spreads throughout the day. Now, this is one stock. This is what we looked at that point. But this was during the deep seek sell-off overnight. But you could kind of see that spread was kind of sitting there at a sort of fairly decent level overnight and during the day. So I think that was
That's wild.
Yeah,
a tighter spread overnight than during the regular trading hours.
Yeah, it was, and that was obviously there was strong conviction on which way the price was going. So people could sort of price that in.
See, you can't come into data with preconceptions, right?
Exactly.
You never know what you're going to see. It's amazing. All right, let's switch over to tick sizes and odd lots. Another sort of hot topic, right? So the SEC proposed a tick size change now a couple of years ago. That change was ultimately adopted to move down to a half penny tick size in the US for tick constrained names. How that's defined and how fees are set is something that is currently very contentious and being litigated in US courts. But as part of that, some changes that have been made to the market data infrastructure were accelerated. And I just got, it was this yesterday, NASDAQ sent out a vendor alert on round lot size changes starting in November. So in the US, we still have this sort of antiquated notion of round lots versus odd lots. And today it's just 100 shares is a round lot, and anything
unless you're buying Berkshire Hathaway.
Right, exactly. Yeah. But if you're buying 100 shares of Berkshire, we should talk. I want to know who you are. But the U.S. markets are adopting new round lot sizes for, based on the price of the stock, because of this issue where so much trading is now happening as odd lots because prices have increased over time, and now some of these companies are very expensive.
Yeah, exactly, and the whole you're right. The whole round lot concept is kind of a very legacy thing, and we obviously it's something which we just don't get in Europe at all. So when we were first coming into the US market, going, well, what's going on here? It's quite confusing, and we're not even going to talk about Canada and its 2 order books that you get for odd lots and round lots, just to make it even more fun. It's something that you do see in a large number of countries. I think the US is probably the most in some ways there's the least understanding about it, because you're right,
Yeah.
so much trades odd lot. And one of the things we've spoken quite a lot about the SIP and the MBBO, the SIP, when you get that MBBO, that shows it to you in round lots.
Right.
The MBBO, the prices that go into making that best bid and offer have to be a round lot. So I can have 99 shares at $100 for my bid, and then that can be 99 shares. The 100 shares could be $95. The MBBO would be $95, not $99. So there's a whole, there's potentially a lot of liquidity that's you're not necessarily seeing if you're just looking at that MBBO. Now the MBBO also has other things with it. The MBBO in the US is order protection, so I can send an order to an exchange. If they're not at MBBO, that exchange, provided I've got order protection on, is obliged to route me somewhere else to get that best price. So there's a lot of infrastructure and there's a lot built out around the round lots and how they do. But as you said, it was set in a very different world where you didn't have electronic trading, you didn't have smart order routers, you didn't have this whole concept of parent and child orders. So now any algorithm, if they're taking an order to execute, say someone does want to buy, 1 million shares, $1 million or $100 million of something, they're not just going to go to the market, buy. They're going to go and break it down into small pieces that they can execute efficiently over time using different mechanisms in order to get the best possible execution, minimize slippage, minimize you were talking about earlier, adverse selection, minimize the price that's going to be moving against you. Because if you just tell the market you want to buy $100 million or whatever price, the market will move against you. Right. And there's a lot of smart people looking at that all the time. So that naturally means that people and traders and firms are breaking down their orders into smaller pieces, which are not at that round lot size. So then firms are looking. The SEC is looking, well, how can it optimize and change round lot rules? One of the first things that's going to happen in the SIPs is they're going to be disseminating the odd lots as well as the round lots. So you'll be able to actually see
finally
and that other price. And it's something that we see a lot of our customers using. So they'll take all 16 of the exchanges that we have, put it into a single best price, and then compare it to the MBBO. And I think I took one stock on a random day, and it was definitely one used to highlight the point, but it was the average spread of it was 37 cents if you took the best possible price over the day. If you use the MBBO over the same window, the average price was 70 cents. God. So that if you're buying something, that is a material difference between.
It's a big deal. And how, and unfortunately, a lot of people make a lot of money because of that lack of transparency, right? That's another problem in markets. It's not just about what you can see, it's about what others can see faster than you. And if you don't have visibility into it, you don't know that you're losing out, right?
Exactly. So that's definitely one aspect, and then the other aspect is tick sizes. So the US, and again, this is different. This is probably, there's lots of other places which do this, but the US has a tick size of 1 cent. I'm ignoring sub-dollar stocks here.
Yeah, and we spent a lot of time on this because we've pushed hard after those SEC proposals were released to actually move to a more European style tick size regime based on the NASDAQ Intelligent tick size proposal, which had proposed to, shrink tick sizes on one side, but increase them on the other, because as the SEC made clear in its proposal, it's better when there are just a certain number of increments in between the tick. And that doesn't just apply to when you're tick constrained. It should also apply on the other side.
Exactly. And I know there's a number of good articles by Phil McIntosh, who's written some good papers on this, and definitely worth checking out those on sort of optimal tick size. And so it's that is definitely that change is looking like it's gonna come in. Although of course there's still ongoing discussions and lawsuits that are happening. But as you said, it's gonna be moved here. What's interesting is in Europe you can still get some other counterintuitive effects. So it's definitely not. There's definitely different ways that you can look at it. But one of the things we've seen in Europe is when things, because in Europe they're all dynamic. So when you move in and out of these boundaries, what you tend to find is you get some, if you're just looking at statistics, like you're looking at the average spread or you're looking at liquidity at BBO, for example. So what's the volume at touch? What's the average number of shares at my best bid offer? You see some really weird jumps if you average it over the day when things move across these boundaries. So we've seen things. We've had customers and we've been talking to people saying, "Hey, I don't understand what's going on here. The liquidity hasn't changed, but my average number of shares at touch has halved." And then we've looked at the price and it's kind of jumped from one to the other. And you've got to remember that tick sizes are dynamic. So you've got to look at it in different ways, or look at it rather than saying, how many shares are there at this price? How many are there within 5 bips or 10 bips or something else? So there's definitely a lot of things to learn from different regions, I think, in terms of finding an optimal tick size. As you said, there's a great plot you can do if you look at, and I don't have this to hand, unfortunately. If you look at the spread in basis points versus the average share price, you find there's this sweet spot where you get like a minimal spread in bits of around $200 in the US. And what you tend to find is companies tend to do stock splits to keep themselves in that nice range where you get a lot of liquidity. And that's one of the reasons why the US tends to have quite a lot of stock splits in that range compared to other parts of the world where, the share price is kind of irrelevant to an extent, because the dynamics just mean that you get a spread. The tick size just adjusts to whatever you're doing. And there's other parts of the world as well. Japan has something kind of half. Europe and the US are kind of the extreme. You've got places like Japan, which are somewhere in the middle, where they've got some bands. It's a bit less dynamic. The difference there, which we've looked at before as well, which is quite interesting, is unlike in Europe and the US, the PTSs, so the secondary trading platforms, don't have to have the same tick size as the primary. So they can do things like make tick sizes a little bit smaller so you can get liquidity inside. What it tends to leave you to is some weird effects where you're looking.
Well, you do have that in the US, right? The wholesalers get to do whatever the heck they want, and the exchanges can't do anything.
Exactly, but you can't see that. That's not pre-trade transparent.
You can't see it for sure.
So the difference here is if you try and say, well, what venue is creating the best price for MBBO, you suddenly go, whoa, what's going on here? There's kind of two prices that are going on, and you just see these little these sort of micro jumps that happen during the day.
Yeah. So you've done this work on optimal tick sizes. So where do you land on that? So what do you think is the right regime? I've heard there was a crazy proposal in the US, and maybe it's because of our constrained tick sizes, but someone was like, you should have automatic stock splits. Why does anything ever trade outside of a band from like $10 to $50, right? Like you hit 50, split down, and that's where you want to be.
So I certainly have a view on that. Share price is arbitrary, right? Market capitalization and the actual economic value of what you're trading is the important bit. It doesn't matter if my price is a penny. If there's a lot of shares outstanding and a lot of free float and a lot of everything else, I can still trade it and get a perfectly liquid instrument to trade, and there's no issue with that. I think the tick size plus the constraints around penny stocks in the US lead to some funny effects and some funny proposals like that. I think no regime is going to be perfect. You're always going to have edge cases. It's always important to look at the data to understand it. I think dynamic tick sizes definitely lead to less funny effects in the order book. One of the things you see if you look at something like Berkshire Hathaway, you see this really, really sparse order book. So you can say, hey, I've got 10 levels of depth, but I've only actually got 10 orders, because everything is just, everyone is just one, because it doesn't
One
matter.
share,
Right? If something's $800,000, I know it's dropped off a little bit since Warren Buffett announced he's retiring. Like 1 cent is like such an inconsequential thing that I might as well just put it in a different price.
Right.
So you tend to get these weird effects, which make it a bit unusable. Europe has complexities too. I don't think I don't think any one system is perfect. It's got these quirks around the bands. It's got the fact that you've got quite a complex system to understand. There's like annual changes. There's whole tables you've got to read for it, and that tends to be quite complicated as well. But certainly, I think there is a sweet spot of looking at what gives you good liquidity from a spread, from an execution point of view. Both, you're right, at small and large tick stocks, and what gives you something sensible that you can use across the board. And I think certainly the move in general to have more tick sizes that are a bit more meaningful, rather than just saying, right, it's 1 cent for everything, does make a difference. And this isn't, by the way, just a thing that happens in equities. There have been changes in we've seen in the past historically on futures markets, on other markets, where they've changed and moved tick sizes as well to try and encourage liquidity. And I think certainly some form of dynamic tick size makes sense in terms of keeping sensible liquidity.
All right. Well, I agree with you on that. I think that intelligent ticks would be a big deal for market quality, especially in the US, which has really suffered from both this dynamic of this fixed tick size and the ability for certain firms to kind of skirt around that and disadvantage exchanges. And one of the drivers, not the driver, but one of the drivers of this massive amount of off-exchange trading that I think we tend to see. But Elliot, I don't want to take up any more of your time. You're in the UK. It is later there. I really appreciate you spending your evening with us and getting a babysitter in order to do so. So thanks for
well, I've heard them crying in the background, but they've been quiet now, so I think they're asleep.
So that's perfect. You get to finish up, and they're already sleeping. What more could you want? Yeah.
Well, look, thanks a lot for having me as well, Dave. It's been a great session, and really good to talk through different market structure ideas.
Yeah, fascinating, and really appreciate the analysis you guys have done and the work you continue to do. So thanks everyone for joining us for another Let's Talk Markets Live. I hope you learned something today. We got deep into the weeds. Certainly send us any questions that you might have, and we'll be happy to answer them in future episodes. And I hope you're all doing great, and we'll see you all next week.
Thanks all.
Thank you.